2025. And I know what Friday afternoons are like. Many of you, probably like the traders we follow, might be mentally checking out already, maybe eyeing those weekend futures. But hold on, before you completely switch off, let's quickly unpack yesterday's action. We're bringing you the intelligence brief for Thursday, September 11th, 2025. Okay, so yesterday we saw these pretty broad rallies across global markets. It's always interesting when things move together like that. So the big question for you is this surge a real signal of renewed growth? Or are we just seeing a market running on the fumes of expected easing maybe? We want to dive into the data behind those headlines.
That's exactly the right question to ask. It's quite fascinating, actually, how these different pieces, data points, policy decisions all seem to converge yesterday. And it really does point towards some deeper trends that investors, well, anyone making decisions really needs to grasp beyond just the surface noise.
And helping us dive deep today is our sponsor, Nextsight. They're a global intelligence and investigations firm. They do more than just collect data. Their OSINT platform, Site Connect, is all about turning raw signals into actual strategy. Clients can tailor reports for exactly what they need. From market analytics to complex cross-border investigations, Nextsight really operates on another level. You can learn more at www.next-site.com. Okay, let's get into those numbers because they were pretty striking yesterday. Global markets were definitely rallying. Here in the U.S., the S&P 500 climbed 0.80%. That's another record close, by the way, at 6,584.31. The NASDAQ composite was up 2.71%, and the Dow led the pack, up a strong 1.35%. We saw gains pretty much everywhere, but materials and consumer discretionary stocks really stood out. And like you said, it wasn't just a U.S. story, not by a long shot. Over in Europe, the Cestio XX 600 rose about 0.5%, 0.51 to be exact, hitting 505.13. That was after the ECB held rates steady. Defense stocks did particularly well there. And Asia, well, Japan's Nikkei 225 hit another record.
It closed up 1.22% at 44,372.45. Seems like tech strength, people mentioning SoftBank, really gave it a boost. So yeah, widespread enthusiasm.
Yeah, absolutely. And if you try to connect these dots globally, synthesize these movements, you really see three main interconnected things driving these gains, I think. First, there's the central bank policy backdrop. The ECB holding its deposit rate at 2%. That was read by the market as sort of a vote of confidence in the Eurozone economy. Stability, basically. The market likes that kind of signal. Second, we got some specific U.S. economic data that definitely added fuel to the fire. Jobless claims came in a little softer than expected, and the producer price index, the PPI figures, also looked modest. Now, why does that matter? Because it kept hopes alive for a Fed rate cut quite soon. The market basically said, okay, the economy's cooling just enough for the Fed to maybe ease up, but it's not falling off a cliff. And the third big piece was, well, tech. Just a real surge in optimism there. You saw strong performance from U.S. chip makers like Micron, Tesla too, of course. And that strength mirrored what we saw in Japanese tech stocks. It really boosted risk assets overall. And this ties into that whole narrative around AI earnings potential, future growth. It keeps pulling investment in.
Okay, so we've got central bank stability, slightly cooler U.S. data keeping rate cut hopes alive, and this ongoing tech excitement. It sounds pretty positive on the surface, but let's circle back to that core question. Genuine growth or just banking on easing? What's the potential downside here? What if those rate cut expectations don't, fully pan out, or if the growth isn't quite as solid?
That's the critical point, isn't it? Because the immediate logic, lower yields, help stocks make sense. But the deeper question is about the durability of this optimism. Is the market pricing in this perfect, Goldilocks scenario, where the Fed cuts just the right amount, inflation behaves, and we avoid any serious economic slowdown? That assumption could be a major vulnerability. If future data doesn't quite fit that narrative, things could get choppy. So for you, watching those growth indicators just as closely as inflation is key right now. This rally is built on some very specific assumptions.
Yeah, a delicate balance indeed. Okay, so while stocks were soaring, we saw some, let's say, counterintuitive moves elsewhere. Particularly U.S. Treasury yields, they slipped quite a bit. The 10-year yield fell back towards 4%, 4.01%. The 2-year down to 3.506%. Now, my first thought is just pure rate cut speculation driving yields down. But is there more to that interplay between falling yields and rising stocks?
Well, your first thought is definitely the main driver. It absolutely links back to what we were just discussing. that softer U.S. labor and inflation data, it pushed Treasury yields lower because investors upped their bets on a near-term Fed cut. Cooling economy makes a cut more likely. And lower yields fundamentally make future company profits look more attractive in today's terms, so that boosts stock valuations. But yes, it also reflects that growing confidence in the rate cut itself, which again highlights that dependency on future Fed action. And following directly from that, the U.S. dollar index, the DXY, it took a tumble, fell 0.29% to 97.50. That was its biggest drop in over a week. Why? Because those renewed rate cut expectations make holding dollars less appealing compared to currencies where rates might hold steady or where the outlook is perceived differently. So logically, you saw other major currencies strengthen. The euro climbed to 1.1741 helped by that steady ECB hand, no doubt. Sterling also gained up to 1.3574, and the yen firmed up a bit to 147.09 against the dollar, again, as those U.S. yields dropped. Oh, and interestingly, the People's Bank of China, the PBOC, they set a stronger fix for the yuan 7.1034 CNY per dollar. Seems like a signal they want to slow down any depreciation there.
Okay, currencies making sense, reacting to those rate expectations, but commodities, they kind of took a hit, didn't they? Oil prices fell. WTI crude down 1.65% to $62.62 a barrel. Brent dropped 1.44%. Even gold slipped a tiny bit. And that does seem a bit weird with equities rallying and risk appetite supposedly up. What gives there?
You're right to flag that. It does seem counterintuitive on the surface, especially with risk assets doing well. But for oil, the story yesterday was very specific, actually. It really came down to supply data. Simple as that. Both WTI and Brent fell pretty much right after the U.S. inventory numbers came out. The EIA's weekly report, it showed a build in commercial crude stocks and also products. Specifically, crude stocks were up 3.9 million barrels. That just signaled more supply than the market was anticipating, simple supply and demand pushing prices down. Bearish signal. And for gold, that tiny slip, 0.09%, down to $3,637 an ounce. It looks like the impact of lower treasury yields, which usually helps gold, was slightly offset by the general risk-on mood. People weren't really scrambling for safe havens yesterday. It shows not everything moves in lockstep, right? Especially when specific factors like oil inventories come into play.
Right, a specific supply story trumping the broader mood for oil. Great point about needing to look under the hood. And just quickly, while we're looking at specific assets, digital assets, Bitcoin saw a small gain, 0.22%, settling around $114,356. Still seems supported by interest in those spot ETFs and, yeah, that general risk appetite. Ether, though, dipped slightly, 0.12% to $4,422. So a bit of a mixed picture there. And one more for you, especially if you're thinking about the housing market, some potential good news. The average 30-year fixed mortgage rate actually fell last week, down to 6.35% for the week ending September 11th. That's down from 6.50 the week before. That directly reflects those falling treasury yields we talked about, makes borrowing a bit cheaper, which, could give the housing market a little boost. Okay, so that's the picture from yesterday. But markets never stand still, do they? Looking ahead, what should you be keeping an eye on? What's coming up that could inject some volatility or maybe shift this sentiment we've been discussing? What's on the catalyst calendar?
Yeah, that's always the next question, isn't it? Thinking about what's next. For today, Friday the 12th, there are really two main things to watch. First, we get the U.S. Producer Price Index, the PPI data for August. After yesterday's figures, this will be watched really closely for more inflation signals. Will it confirm the cooling trend or challenge it? Big implications for those Fed rate cut bets. Second, maybe less on everyone's radar, but important, is the Fitch review of France's sovereign debt rating. There's a possibility of a downgrade from LEA maybe down to A plus FE. Now, if that happened, it could trigger some forced selling of French bonds and definitely widen European credit spreads. Could throw some cold water on that European market optimism we saw. And then looking into next week, it's pretty packed. The big one is the U.S. FOMC meeting, Tuesday and Wednesday, September 16th and 17th. Markets are already pricing in a very high chance of a 25 basis point rate cut there. But the statement, the tone, the projections, that will be huge. Plus, we get Eurozone inflation data, the HICP figures, and the Bank of England also has its policy meeting. So yeah, next week could really set the tone, either confirming the current narrative or forcing a rethink.
Wow, okay. So definitely some key decision points coming up thick and fast. It really drives home how interconnected all this is. Like you said earlier, ripples everywhere. So let's make this practical. If you are listening, maybe you're a CIO, a CFO, managing risk for your company, what are the actionable takeaways from all this?
Yeah, let's try and translate that. Stepping back, what does it all mean? For chief investment officers, I think the takeaway is that falling U.S. yields and these renewed rate cut bets, they do tend to support longer duration equities, at least for now. So the upcoming FOMC meeting becomes absolutely critical for confirming that policy path. You'll want to listen closely to the Fed's language on future easing. Also, keep an eye on oil. Those rising inventories and falling prices, if that continues, it could start to weigh on energy stocks and maybe dampen inflation expectations a bit. That could shift allocations. For CFOs and corporate treasurers, that retreating dollar and the stronger euro, that might open up some windows, maybe opportunities to lock in USD funding at better rates, or perhaps adjust currency hedging strategies. And relatedly, that drop in mortgage rates we mentioned, that could spur some refinancing. If your company has revenues linked to housing, assessing that sensitivity is probably wise right now for financial planning. And finally, for risk managers, especially those with European exposure, hedging positions in French government bonds might be a prudent move ahead of that Fitch review today. Even if nothing happens, the potential for spread widening exists. Being proactive there could mitigate some downside if there's a negative surprise. It's really about anticipating, not just reacting.
Excellent points. And if you need intelligence that helps you anticipate instead of just react, that helps you stay ahead, check out Nextsight. They support executives, analysts, and investigators all over the world, delivering insights that are not just reliable, but genuinely actionable. Find out more at www.next-site.com. All right, that brings us to the end of our look at the Thursday, September 11th, 2025 Intelligence Brief, delivered here on Friday, September 12th on The Deep Dive. Hey, don't forget to subscribe wherever you get your podcasts, YouTube, Spotify, all the usual places, and please do drop us a like, a share, maybe a comment. We genuinely love hearing your perspective. And with that, may your Friday be, let's say, more stable than a trader's willpower at 4 p.m.
And maybe a final thought to take into the weekend. Consider how these daily shifts we talk about, bond yields, oil prices, currency moves, they aren't just random numbers flashing on a screen. They're actually critical signals within this much larger interconnected economic story. And understanding that deeper narrative, especially that tension between what the market expects and what the economy delivers, well, that's where the real opportunities lie for those looking beyond the day-to-day headlines.